Hello and welcome to Session 16 of the Basic Tax course. We're going to begin Session 16 with a review of the Session 14 quiz answer key. I have the Session 14 quiz up on the screen in front of you, and the most frequently missed, or the first of the most frequently missed questions from Session 14 quiz is question number 1. Which of the following is a capital asset? Inventory held for sale to customers, depreciable property used in a trade or business, a painting created and owned by the artist, or investment use property. And as you can see, the correct answer is investment use property. Investment use property is a capital asset because it's held by you and it's not used, and this is for business purposes. An example of investment use property would be a stock portfolio. That would be a capital asset. But inventory and depreciable property used in a trade or business, that is not a capital asset. A painting created and owned by an artist, that too is not a capital asset because it was created by the artist from his or her own personal efforts and doesn't meet the tests. Number 4, Jane sells property she received as a gift. The fair market value at the time of the gift was less than the donor's basis. She sells the property at a gain. Her cost basis is the fair market value of the property on the date she received it, plus or minus any adjustments to the property during the time she held it. That is a false statement. In fact, it's the opposite of the truth. She sells the property she received as a gift. The fair market value at the time of the gift was less than the donor's basis. If she sells it at a gain, she's going to go with the donor's basis. She is not going to go with the fair market value. So if she sells it at a loss, she'll go with the fair market value. But if she sells it at a gain, she's going to go with the basis. Number 6, points you pay on behalf of the buyer of your home are deductible by you on Schedule A. That is false. That is also the opposite of the truth. Points that you pay on behalf of the buyer of your home would reduce your net profit from the sale of your home. They are not deductible by you. They are, however, deductible by the person who buys your home. Question number 14, your pet dog is a capital asset, and that is a true statement. A lot of people have a hard time understanding how your pet can be a capital asset. Well, your pet is personal property owned by you and not held for business, so there you go. 15, if you sell property you inherited at a loss, your basis is generally the fair market value of the property on the date you received it, plus or minus any adjustments to the property during the time you held it. Well, that's a big fat false. You have to look to the date of death or 6 months after the date of death, whichever date is established and used by the estate. You do not look at all to the date you received the property, which could be months or years after the date of death. Rather, the property is revalued as of the date of death, and basis is a match to what the value was on the date of death. And the only exception to that rule is if the estate selects a date that is 6 months after the date of death. But again, going back to the statement, the date you received it, well, that's never the case. So that concludes the review of the Session 14 quiz answer key. It is now time to move on to the Session 15 homework assignment. The Session 15 homework assignment was to establish which of the following assets are depreciable. And we begin with question number 1. Your personal car, which you do not use for business, is that a depreciable item or depreciable item? The answer is no, it is not. That's a false statement. A truck you use 65% for business, is that depreciable? Yes, it is. That is a true statement. Number 3, your qualified home office in a home that you own, is that depreciable? Yes, it is. It would be depreciated over 39 years because it is a real estate used for business, depreciated over 39 years. 4, a hand tool with a useful life of 6 months or more you use for your business, is that depreciable? The answer is false. No, it is not. An asset that is placed into or taken out of service in the same year is not depreciable, and also an asset with a useful life of 1 year or less is not depreciable. A photocopier you bought and sold in the same year, is that depreciable? The answer is false. It was placed into and taken out of service in the same year and therefore is not depreciable. Land, false. Land is never depreciable. Number 7, improvements to land that are used for business. Are those depreciable? Well, we're going to say true, but it could be false. It all depends. And if you look in IRS publication 946, it does show you that improvements to land have a depreciable life of 15 years, but there are some caveats or rules to be aware of, and those are that if the land improvements are not immediately adjacent to an improved house or a building, and rather they're separate and away from the building, then IRS says that land improvements are not depreciable. So it just depends. Number 8, your personal car, which you use 30% for business in your business activity, is that depreciable? And the answer is yes, but your depreciation deduction would be limited to 30% of the normal depreciation on the car. Number 9, Section 197 franchise startup costs totaling $25,000. Are those depreciable? Well, technically false. You do not depreciate intangible assets like franchise costs. Those are amortized. And question number 10, your laptop computer, which you use 85% in your business, is that depreciable? And the answer is yes, it is. That's a true statement. So that concludes the review of the Session 15 homework answer key. It is now time to resume our lecture on depreciation, and we're going to pick up on depreciation, I believe, on page 42 of your manual. So at the end of our last class, we finished off with page 41. After taking a look at how to claim depreciation on vehicles, we're now going to begin at the top of page 42 with special rules regarding leasing a vehicle. Now let's suppose we take a look at these depreciation rules, and we look at the limits on those depreciation rules, and we also look at maybe a way out of that by saying, I'm just going to lease the car. It's going to be a lot easier. Do you think that's the solution? Well, it can be. It really depends on the particular client. I frequently get phone calls from clients who say, yeah, I'm looking at buying a new car and they're suggesting I lease it. Can I do that instead? Is that a good idea? Well, it depends. If you're going to be using the vehicle according to the conditions of the lease and you plan on turning it in at the end of the lease, without having extended yourself beyond any of those conditions. For example, the lease might provide for a certain number of miles to be driven, and if you go over those miles, you're going to be charged an extra amount. If there's any damage to the vehicle, you're going to be charged for that. So if you're prepared at the end of the lease to come out of pocket for anything that you need to, and you plan on doing that at the time, then it could be a lease is a good way to go. And then you'd just be rating off the business use percentage of each monthly payment, and that would keep it simple, right? But ultimately, of course, a lease factors in depreciation, it factors in the cost of the property, it factors in interest on the payment on that property. It's factoring in a bunch of things, and in the end, you don't win financially in a lease. You don't come out ahead financially in a lease in most cases. They're designed really to favor the lessors, not the person who is taking out the lease. But let's just suppose you are a person who has decided to lease rather than buy. There are some additional rules that you have to pay attention to. If you lease a car, truck, or van that you use in your business, you can use the standard mileage rate, or you can claim the actual expenses when you figure your deductible expense. How you go about deducting lease payments is the next part there. If you choose to claim actual expenses for your leased car, you can deduct the portion of your lease payment that corresponds to the percentage business use subject to the following restrictions. Number 1, you cannot deduct any part of a lease payment that is for personal use of the car, such as commuting. Number 2, you must spread any advanced payments over the entire lease period. So for example, if you had to pay $2,000 down when you took out that lease, that $2,000 down payment has to be spread over the life of the lease. You don't get it up front as a lease payment in that first year. You cannot deduct any payments you make to buy a car, even if the payments are called lease payments. So in effect, what that's saying is if you go to the bank and you find out that the cost of buying the car is going to be $600 a month, but the cost of leasing the car will only be $300 a month, you go, I think I'd rather lease it. And then at the end of the lease period, I'm just going to buy it out for what's left, because that'll give me a lower payment later on. The IRS says that's in fact a purchase. And a purchase that's called a lease is still a purchase, and so you shouldn't be treating the lease payments as lease payments. You should be treating them as payments on the car itself, and figuring out what portion of each payment is interest, and of course claiming depreciation. So the facts and circumstances of the case really establish whether it truly is a purchase or whether it's actually a lease. And how I establish that is simply by asking my customer, do you plan on keeping this car, or are you going to turn it in at the end of the lease period? And based on their answer, that's going to be how I treat it. Now, if you lease a car that you use in your business for a term of 30 days or more, you may have to reduce your deduction for the lease payment by something called an inclusion amount. Have any of you ever heard about inclusion amounts before? It comes up periodically in discussions, and I got a little bit interested in what an inclusion amount was one year, and I decided to put it in my course after I figured it out. And inclusion amounts are discussed in publication 463, page 25, and in a nutshell, I'm going to tell you how those rules work. If you've never bothered with an inclusion amount on any of your tax returns that you've ever prepared for a client, you have probably done no great hardship, because you'll almost laugh at what the inclusion amount comes to when we're done. But I'm going to explain it to you. The inclusion amount is a percentage of the part of the fair market value of the leased vehicle multiplied by the percentage of business and investment use for the car for the tax year. It is also prorated by the number of days in the lease term in the tax year, and you must apply the inclusion amount each year you lease the car if the fair market value of the car at the time you began your lease is more than the amount shown on the table. And it wouldn't be hard to purchase a new car with a fair market value of more than $19,000 under a lease. I suppose it is possible you could get a used car that's under $19,000, and if it is, then you don't have to worry about inclusion amount. But if you purchase a car that has a fair market value more than the amount shown on the table, in this case $19,001, that would be more, then you have to figure an inclusion amount. So let's see how that works. Calculating the inclusion amount for a leased vehicle. Firstly, publication 463 has 3 appendices in it. Appendix A is for cars, Appendix B is for trucks and vans, and Appendix C is for electric cars that were leased during this period of time, 1997 through 2007. Also, if the fair market value of the car is $100,000 or less, use the appropriate appendix to determine the inclusion amount, and if the fair market value is more than $100,000, see the revenue procedures described in the footnote of the appendices to figure out how to manually figure the computation. Now, for each year during which the car is leased for your business, you determine the inclusion amounts in these steps. Step number 1, locate the appendix that applies to you and find the inclusion amount. Then find the line that includes the fair market value of the car on the first day of the lease term. Then go across the line to the column for the tax year in which the car is used under the lease to find the dollar amount. For the last tax year of the lease, use the dollar amount for the preceding year. Step number 2, prorate the dollar amount from 1B for the number of days of the lease term included in the year. And in step 3, multiply the prorated amount by the percentage of business and investment use for the year. This will give you your inclusion amount. Okay, all of this to get a number. What am I going to do with that number? We'll see. Here's an example. On February 1, 2011, McQueen leased a car for 3 years and began using it in his business. The car had a fair market value of $42,500 on the day he signed the lease agreement. His monthly lease payment is $600. McQueen used the car 70% for personal or 70% for business during each year of the lease. Use Appendix A6 to calculate the following inclusion amounts for the year. So for 2011, which is the year he purchases the vehicle, the table is telling us that the inclusion amount is $27. This is what I said, it's such a joke. All of this work to get these paltry little numbers. The dollar amount is $27, and he's going to prorate that by the number of days in the year that it was used in business. So 334 out of 365 days it was used for business. He multiplies that by the business use percentage, and he gets an inclusion amount of $17. Now, interestingly, the inclusion amount goes up over time. So when the car is newer, the inclusion amount is smaller. And as the car ages, the inclusion amount goes up. It's counterintuitive if you ask me, but I'm very simple, so I don't always understand where these things come from. We'll see. All right. Then for 2012, the dollar amount from the tables is $60. It'll be a full year, so we just multiply that by 70%. We get $42 as an inclusion amount for 12. In 2013, the inclusion amount is $89. Multiplied by 70% gives us $62. And for 2014, the inclusion amount is the same as for the preceding year, $89. But it's only going to be used for 31 out of 365 days, so the inclusion amount comes out at $5. Now, for each year of the lease, McQueen has to do a calculation to determine his inclusion amount. And here's how it works. Firstly, he finds the inclusion amount on the appendix, which we've already done. And for the first year, we show that it's going to be $27. We multiply 27 by the ratio for the number of days it was used in the business, and that gives us $25. Then we multiply the prorated dollar amount by the percentage business use, and we get $17. For 2011, assuming McQueen made 10 lease payments for his car during the year, his allowable lease deduction would be $4,183 for his car, and this is how we figure it. 10 payments times $600 gives us $6,000, and we multiply that by 70% business use, and we get $4,200. Here's how the inclusion amount works. He's not allowed to claim $4,200 as a deduction. Instead, he has to go take that inclusion amount and subtract it from $4,200. The inclusion amount is $17, so his deduction is going to be reduced to $4,183. This is why I was laughing. If you never figured an inclusion amount, it's probable that an IRS auditor will change nothing because this $17 difference won't amount to much. But as I said, as you go through time, the inclusion amount increases each year. In year number 2, he still has the same $600 payment on the car. That's $7,200 of payments for the year. The inclusion amount is $60 times 70% or $42, so he subtracts $42 from $5,040, and that gives him his deduction in the second year. In the third year, after inclusion, we have a deduction of $49.78, and in the fourth and final year, when the lease term ends, we have a deduction of $415 rather than the $420 that you get by multiplying the business use percentage by the lease payments. Here is a cutout of the table. The fair market value or contract price of the car is $42,500. It is leased in 2011. So you can see each table is for a different year. This table is 2011. So I find the line, and here it is, $42,000 to $43,000, and there's that first year inclusion amount, that $27. That's where I got it. The second year is $60. The third year is $89. The fourth year would be $107, but in the final year we use the same number as the year before, $89. So the next page we have here is just a summary of the highlights of what we've been talking about for the last couple of hours. The amount of depreciation and Section 179 deduction you can claim on passenger automobiles is limited. Passenger automobile is any four-wheeled vehicle designed primarily for use on public streets, roads, and highways and rated at 6,000 pounds or less. Passenger car limitations and listed property. Depreciation limits apply to passenger cars weighing 6,000 pounds or less, but SUVs and vans weighing more than 6,000 pounds are still listed property, and a Section 179 deduction is only allowed for business use that is more than half. We have the table, and the table affects how much your limit on the passenger automobile will be. It is affected by whether you take bonus or not, and in years where you elect out of bonus, your deduction is less. In years where you elect into bonus, or do not elect out of bonus rather, the deduction is the higher number. Password number 1 is subspace, S-U-B-S-P-A-C-E. Okay, we're on to the standard mileage allowance. Oh, I do see a question here from Whitney before I move on. What if a client is claiming mileage for vehicles? Can they still be depreciated? No. The standard mileage allowance is claimed instead of everything else, and we're getting onto that here. I'll talk about it more. And then what if a client does lease a vehicle and does want to write it off? Schedule C will not allow you to take the standard deduction for mileage because it is not an owned car. Okay, here's the deal. The standard mileage allowance is claimed instead of depreciation and actual expenses for the car. So you would never claim standard mileage allowance plus these other deductions. It's one or the other. And then Whitney's also saying, I'm confused when and how and whether to use makers or acres. The answer is acres is extinct. You will never deal with acres. You will only deal with makers. And then the final question, even if vehicle is 100% business use, question mark. I'm not sure what you mean by that question, so you can clarify it. Okay, moving on with the rest of our class. The standard mileage allowance is where we're at now. So you can claim the actual expense of operating your car, or you can claim a standard mileage allowance, but never both. For 2011, there are two standard mileage rates in play. For the first half of the year, it was 51 cents per mile, And in the second half of the year, it went up to 55 cents, 55.5 cents per mile. This is not an unusual situation. I would say 30% to 40% of tax years, there are two standard mileage rates in play. And the reason there are two is because of fluctuations in gas prices. So at the start of the year, 2011, gas was less money. As we went through the year, it increased, and so the standard mileage amount was increased halfway through the year. And the way gas prices are going in 2011, it would not surprise me if 12 has another mid-year increase. Back in 2008, when gas prices hit $4 a gallon, the standard mileage rate was increased in the last half of 2008 to 58.5 cents a mile, and gas prices are now where they were in 2008 by my pump observations. So I'm predicting we might see a July 1 increase to 58.5 cents a mile, or it could be I'm full of hot air and I don't know anything. All right. These rates, the standard mileage rates, are meant to cover all of the costs of operating your car, including gas, oil, repairs, and depreciation. If you claim the standard mileage rate during 2011, 22 cents of each mile you claim is depreciation, and the remaining 29 or 33.5 cents per mile is allocated to the operational cost of the vehicle. While Makers limits your depreciation when claiming the actual cost of operating your car, if you claim the standard mileage allowance, that limit does not apply. So here's the deal. I love the standard mileage rate. It is simple, it is clean, it is easy. You don't have to worry about depreciation and depreciation limits. You just claim the standard mileage allowance. Not only that, if your client bought a really cheap car, they can be claiming a much better tax benefit under the standard mileage rate than they would ever get by claiming actual expenses. So quite frankly, the only people I ever recommend actual expenses to are people who have very expensive vehicles that they drive short distances. If you have an expensive car and you don't drive it very far, then you're going to, but most of the time you do drive it as business use, you're going to have some nice big deductions to go with it. But if you have a cheaper car that you pound the miles on, you are way better off with the standard mileage allowance. Really, if you drive 10,000 miles, the standard mileage allowance is going to give you a $5,000 deduction. You've already dwarfed the limit on the limit on automobiles in most years just by doing that. So it's really the way to go. Now there's a couple of things you should be aware of, and one of them is that with regards to tires, the IRS has ruled that when you purchase a car, it does come with tires in most cases, and that the tires that are on the car when you purchase it are part of the acquisition cost of the vehicle. But later, when those tires wear out and you replace them, the cost of replacing the tires is a repair and not an improvement. Therefore, if you're claiming the standard mileage rate, the cost of new tires will not add to your basis in the car. They would be a maintenance issue with the car and considered to be part of the standard mileage rate. And if you are claiming actual expenses on your car and you replace the tires on that car, you do not depreciate them. They would be a maintenance expense that you claim in the year, obviously multiplied by percentage business use. Oh, we are up to amortization. We're on part 6 of Form 4562. We have to start changing the way we think about things because we're not talking about Makers anymore. We're into a whole new world. Makers was everything we needed to know about depreciating property that is tangible, personal property, or real estate. Now we're moving into this realm of amortization, and amortization affects those intangible assets like going concern value, goodwill, franchise fees, patents, trademarks, things of that sort. So amortization is a method of recovering or deducting certain capital costs over a fixed period of time. It is similar to the straight line method of depreciation. In general, you cannot depreciate intangible property placed in service after October 10, 1993, but the following property cannot be depreciated and must be amortized, including geological and geophysical expenditures. And you'll notice next to each of these I have a section code described. That section code is important because anytime you amortize property, the IRS wants to know what section code you are claiming amortization under. And so you have to go to that section code and follow the amortization rules that apply to that code. And if we go to that, I think it's page 54, to look at page 2 of the 4562. I typed 84 instead of 54. There we are. page 54, we get down to this amortization section. There's this box D. See, here's part 5 or part 6 amortization. And we go over to this column and it says amortization code. What do you put there? You put the codes that I just started to explain to you. What page was I on, folks? Thank you. All right. Next one in line is pollution control facilities. That's their section code. Then we have certain bond premiums, research and experimental expenditures, the cost of acquiring a lease, section 178. That has to be amortized. Interesting. Qualified forestation and reforestation costs, optional write-off of certain tax preferences over a period specified in section 59E. I did not look that up. I don't know what that means. Maybe one of you knows. Certain section 197 intangibles including, oh, these are interesting because this is just about everything we'd ever amortize is falling under this section. This one you need to know. Interestingly, section 179 and section 197 have the same 3 digits, but they're completely different sections. They both have something to do with depreciation and amortization, and don't confuse them. So section 197 intangibles include things like goodwill, going concern value, workforce in place, business books and records, operating systems, or any other information base, a patent, copyright, formula, process, design, pattern, know-how, format, or similar item. A customer-based intangible, for example, composition of market or market share. A supplier-based intangible, a license, permit, or other right granted by a governmental unit. A covenant not to compete entered into in connection with the acquisition of a business, and a franchise, trademark, or trade name, including renewals. Also, business startup costs are an intangible asset that needs to be amortized, and those fall under section 195. The organizational costs for forming a corporation fall under section 248, and the organizational costs for a partnership fall under section 709. So now you know all of the codes that you might need to reference when you're filling out part 6 of Form 4562. All right, let's see what comes next. There's this special rule relating to creative property costs. And I can only guess that there was a specialized group of people who managed to lobby the right people to get this one. These are costs paid or incurred to acquire and develop screenplays, scripts, story outlines, motion picture production rights to books and plays, and other similar properties for purposes of potential future film development, production, and exploitation. You may be able to amortize creative costs for properties not set for production within 3 years of the first capitalization transaction. And they are amortized ratably over a 15-year period. You need to read Revenue Procedure 2004-36 and 2004-24 or Internal Revenue Bulletin 1063 if you really want to know more on that topic. Also, reforestation costs. You can elect to deduct up to $10,000 of reforestation costs paid or incurred after October 22, 2004. Costs that are not deducted currently can be amortized over an 84-month period. Startup and organizational costs. This is probably the biggest, most common one that I deal with because customers come to get their tax returns done by a professional very often for the first time when they acquire a business. I've just bought a business. It's time to hire a professional, so they come on in. And if you've just started up a business, you can have startup costs. And if you've purchased an ongoing business, you can still have startup costs. One of the better examples that I had to work with in recent years was a business that 2 employees bought out their employer's resale business. It specializes in reselling video games and DVDs, that type of thing. And it was a multi-store enterprise with lots of old assets. You know, it had inventory, it had display bins, it had display cases, it had countertops, it had signage, it had carpet, it had fixtures, all in multiple stores. It also had workforce in place, all kinds of stuff, a lot of stuff. And all of these had to be separately identified so that we could begin depreciation and amortization on them. And what is not uncommon is there was no breakdown in the sales agreement for those amounts. The buyer and the seller, just between them, agreed what the purchase price of the business was going to be. And somewhere in all of that, we had to figure out what the fair market value of all the hard assets was and what the fair market value of the intangible assets was. It was quite a bit of work. So it's not at all uncommon for business owners to just shake hands, come to an agreed sales price, sign off on it, and then come in and see us. And our job at that point is, okay, now what do I do? So really what we have to do is break everything down into its component parts. So let's talk about that in a little bit more technical detail. So when you start up a business, you treat all eligible costs you incur before you begin operating the business as capital expenditures which are a part of your basis in the business. Generally, you recover costs for particular assets through depreciation deductions. However, you generally cannot recover the other costs until you sell the business or otherwise go out of business. You can elect to amortize or, with certain limits, deduct the following costs for setting up your business. These include business startup costs, organizational costs for a corporation, and organizational costs for a partnership. So let's talk about business startup a little bit. Now, my clients who purchased this ongoing business, they had a small amount of startup, but they had a lot more of other kinds of intangibles. Because startup is a very specific kind of thing, and if you buy a going concern business, you're not going to have a lot of startup. Startup is something that an expense you incur before you open your doors for business. And if you buy a going concern business, it's already open, right? So yeah, we call that a turnkey operation. So business startup more often falls in line when you are just figuring out what it is it's going to take to open up this business. You're researching it, you're traveling, you're talking to people. Finally, you identify what it is you're going to do for your business. You secure a lease. You start buying equipment. You start hiring people. You start training them. You start purchasing inventory. You start stocking the shelves. You place grand opening advertising. You get a website going. Where do you draw the line? Is all of that startup? Is some of it not startup? Well, all of this is defined for us, and we just have to go to the rules on each item and decide where it falls. Startup costs are amount paid or incurred creating an active trade or business or investigating the creation or acquisition of an active trade or business. Startup costs include amounts paid or incurred in connection with an existing activity engaged in for profit and for the production of income in anticipation of the activity becoming an active trade or business. So you can have startup when you're actually looking to get into a new business completely. You can also have startup if you're already in business and say you're deciding to launch another store. You're adding another store. Business startup and organizational costs can be capitalized, amortized, or with certain limits deducted. If you choose to amortize your business startup costs, you must amortize them over 180 months. That's 15 years. Organizational costs include the cost of creating a corporation or a partnership. And then we move on to qualifying costs. A startup cost is amortizable if it meets both of the following tests. Number one, it is a cost you could deduct if you paid or incurred it to operate an existing active trade or business in the same field as the one you've entered into. It is a cost that you pay or incur before the day your active trade or business begins. So it's all of the costs associated with operating a business, except you're not actually open yet. That's an illustration of startup. Startup costs include amounts paid for the following: an analysis or survey of potential markets, products, labor supply, transportation, facilities, etc. Advertisements for the opening of the business. Salaries and wages for employees who are being trained and their instructors. Travel and other necessary costs for securing prospective distributors, suppliers, or customers. Salaries and fees for executives and consultants or for similar professional services. So what you can see here is you could have a client who comes to you and says, my total payroll for the year is shown here on my W-3 transmittal slip. This is my total payroll for the year. But it doesn't mean that all of that payroll is deductible as payroll if this is the year they open their door for business. Because it could be that some of that payroll needs to be allocated to a point in time before the business opened. And the portion of payroll and all of the payroll taxes allocable to the period of time before the business opened are part of startup. And startup needs to be capitalized and then amortized. Startup costs do not include deductible interest, taxes, or research and experimental costs. If you purchase an active trade or business Amortizable startup costs for purchasing an active trader business include only the investigative costs incurred in the course of a general search for or preliminary investigation of the business. These are costs that help you decide whether to purchase a business. Costs you incur in an attempt to purchase a specific business are capital expenses that you cannot amortize. Disposition of a business. If you completely dispose of your business before the end of the amortization period, you can deduct any remaining deferred startup costs. However, you can deduct these deferred startup costs only to the extent they qualify as a loss from a business. How do you make the election to amortize startup costs? Because it's not an automatic thing. You actually have to file a formal election that, hey, I want to amortize startup. Because if you don't file the election, then the startup is just capitalized, and you realize the cost of startup when you dispose of the business. To elect to amortize startup or organizational costs, you complete and attach Form 4562 to your return for the first tax year you are in business. You may also be required to attach an accompanying statement to your return. For startup or organizational costs paid or incurred after September 8, 2008, the statement is no longer required. If you have both startup and organizational costs, attach a separate statement if required to your return for each type of cost, and again, the statement is no longer required. So it seems to me it's enough that if you list startup costs on your tax return with the appropriate code, the IRS is going to be able to identify that. And if you list organizational costs on the amortization portion of the return with the appropriate code, the IRS can identify it. So it seems almost to me personally that the statement was redundant, and so they've done away with it. Now, generally, you must file the return by the due date, including any extensions. However, if you timely filed your return for the year without making the election to deduct or to amortize the startup costs, you can still make the election by filing an amended return within 6 months of the due date of the return, including extensions. Once you make the election to amortize startup or organizational costs, you can never revoke it. Now, many of you will remember the olden days before 2004, when startup costs were amortized over 5 years instead of 15 years. Again, that magic date in 2004. Any startup costs incurred after October 22 have to be over 15 years, but anything done before 2003 is amortizable over 60 months. Now, there is a little bit of a break for small business owners. Even though amortization is now 15 years instead of 5, there is this upfront deduction that you are allowed to claim that never used to be there. And the upfront deduction is a maximum of $5,000. So if you incur startup costs after October 22, 2004, you can elect to deduct up to $5,000 of startup costs as well as $5,000 of organizational costs. The maximum deduction is reduced by the amount by which your organizational or startup costs exceed $50,000. So if your small business spent more than $50,000 getting ready to open its doors for business, you would not be able to claim a full $5,000 deduction. But if you spent $50,000 or less, you can deduct up to $5,000 in that first year, and then you amortize what's left over 180 months. I've got an illustration here for Fred Finch, just to show you the types of expenses that a business might have in the formation stage of starting up. Fred Finch incurred the following expenses as he prepared for 2011 grand opening of his new business for the Birds, Inc. He paid organizational costs of forming a corporation, which totaled $2,000. He paid travel costs while researching competing businesses of $1,000. He had meal expenses while traveling for business of $200, and he paid 2 months' rent before the grand opening in the amount of $3,000. He had auto mileage prior to the grand opening of $500. Opening soon advertising of $2,500, payroll for training staff and getting the business ready to open of $4,000, payroll taxes paid prior to the grand opening of $400, and utility costs for 2 months before the grand opening of $500. He also purchased a bunch of inventory, $50,000 in inventory. So how is he going to allocate all of these costs? Well, under the startup cost category, which is section 195, he will make an entry on Form 4562 in Part 6. But he's also able to claim a deduction of up to $5,000 of startup if he wishes. So the Section 195 startup costs include travel costs of $1,000, the meal expense of $100, because he's only allowed half the meal, right? And 2 months of rent paid before the grand opening, his auto mileage, his opening soon advertising, payroll for training staff, payroll taxes, and utility costs. All of those total $12,000. That's his startup amount. He can elect to deduct up to $5,000 of startup costs as a current year expense by entering it directly on his business return as an expense. And then he can amortize the remaining amount over 180 months. Or he can just amortize it all. That's up to him. The second aspect is the organizational costs of forming his corporation. They fall under Section 248, and that $2,000 amount can be either deducted or amortized because his total amount is less than $50,000. And then he has the cost of goods sold, which are the inventory purchases. $50,000 would essentially be his purchases for the year, and how much he gets to deduct as an inventory deduction, you need a lot more information than this number. We need to look at his opening inventory, we add in all purchases for the year, we subtract out the closing inventory, and he will claim that as a cost of goods sold deduction. 2010 startup expenses, if any of you remember it, for 2010 only, we had a one-time rule that allowed up to $10,000 of startup expense and organizational costs to be deducted rather than only $5,000. And that began a phase out when the startup costs exceeded $60,000, but that's in a play only for 2010 returns. How do you claim amortization? You claim it in Part 6 of Form 4562. Password number 2 is Gollum, G-O-L-L-U-M. So I'm just looking at the amount of time we have and what it is I want to try and cover in the rest of the day. And there's obviously no way you can all spend time working on 3 more illustrations, plus have me finish the lecture, plus show you how depreciation works on our software. So we'll just get as far as we can with all of that. And if we don't get through all of the classwork assignments, you can read the problems and look at the answer keys in your own time. A lot of depreciation comes just from sitting there quietly mapping out how everything works, and some people learn faster than others. So I would say time after class will be the best way for those of you who are still feeling confused at the end of the day to solve some riddles. But at any rate, we've got the depreciation schedule up in front of you for the business use assets that were placed in service during the year. And my the request of you was to go through these and to enter them onto Form 4562. So of course, when we're dealing with the car, we are dealing with a form of listed property, and that, therefore the car is going to need to be entered in Part 5 of Form 4562, and it is 51% or more business use, so it's going to go on line 25, is it? 26? So yeah, it's going to go on line 26. The next one in line is the commercial office building. That's going to go in Part 3 of Form 4562. And the cell phone is no longer listed property. It is 7-year property, and it will go on line 19C. The laptop computer is listed property used less than 51% for business use, and so it will go in Part 5 on line 27. The desktop computer is not listed property because it is used at a regular business establishment, and therefore it is 5-year property that will be entered in Part 3 on line 19B. And the final one is the desk. It is 7-year property, and it would go on line 19C. However, we're Section 179ing those two things, aren't we? The computer and the desk and the desktop computer. So they ultimately, because they're being Section 179, don't get listed on line 19 at all. They go up on Part 1 and get listed there for depreciation under Section 179. So does all of that make sense to you so far? You were kind of on track for those items? No, in the case of those two assets, the desk and the desktop computer, they're going to be fully deducted under Section 179. There's no residual amount carrying over to those other lines. But if we were not claiming a Section 179 deduction, it would be lines 19B and 19C that we would use. And in this case, we are not using 19C or 19B. We're going up under Part 1, and we're going to enter them on line 6. And then, of course, the car, because we're claiming a Section 179 deduction on it, we're going to make an entry in the Section 179 column in Part 5. And then we go over to the second depreciation schedule, this baby right here, where we have rental property. And, of course, we're going to have to complete a second Form 4562. You don't put rental information and the Schedule C information on the same 4562. There needs to be two 4562s. So this rental house goes on a separate 4562. The rental house itself will go on line 19H, and the refrigerator is 5-year property that will go on line 19B. So having explained all of those details, let's take a look at the answer key. And this answer key that you're about to see can be printed in its entirety using the password that I gave you earlier. And it contains all kinds of written analyses to describe the logic of what we've done, which I will allow you to read in your own time, including at the start of the class after our lunch break, I asked how many of you had calculated 3570 on the car. And how you arrive at that 3570 calculation, and how ultimately you end up with a $1,561 deduction on the car instead. So it describes that in detail. All of the other computations, how to manually calculate them, are in here. But the final point that I want to get to is just to show you the 4562s. So let's get to them. And we have the 4562 for the Schedule C, and you will see that the 4562 has a space where it asks you to enter the business or activity to which the form relates. And the software automatically determined that for me when I told the software that I wanted it to carry the Schedule C. And since there's only one Schedule C in my software, it knew to put C1. But if I had two businesses in my computer, I would need to tell each depreciation schedule which business or which line item on each depreciation I enter, what business it needs to carry to. And in the case of this exercise, I actually do have a Schedule E and I have a Schedule C, and so the Schedule C items are carrying to this 4562 and the Schedule E will go to a different one. My computer will only know to do that if I tell it that. It's not a mind reader. It won't know this information unless I tell it. So here we have the limit on the Section 179 deduction is $500,000. The next question in line is the total cost of Section 179 property placed in service for the year. This stumps people. Where does that number come from? And the way you get that number is you take all of the property that could be eligible for the Section 179 deduction during the year, you multiply that the property that has a business use percentage that applies by the business use percentage, and then you total all of that up and put it here. So of course line 2 would not contain any part of non-business use, nor would it contain the cost of any property not eligible for the deduction. But the amount we enter on line 2 is not necessarily in any way going to correlate to the amount of Section 179 deduction we actually claim. It's just the amount of property that could possibly qualify if it met all of the tests. And these are the ones we're going to deduct. So we have the desktop computer and the desk, and both of those have a cost, and both of those have an elected cost that are the same number. And then it says listed property, enter the amount from line 29. Well, the $1,561 deduction is the Section 179 deduction we're claiming on that car. And we total up our Section 179 deduction, and we get $2,811. That is not being limited by the income of the business or by the excess amount up here on line 2 being too high. Obviously, we had to give our business income for that to be the case. Then we have maker's depreciation for assets placed in service before 2011. Well, where did that number come from? The only asset in use in this business that was placed in service before 2011 is the commercial building. Because what year was the commercial building placed in use? 2010, and what months? So let's go up and see what happens with that. This is the office building. We have to subtract the land value of $75,000, and we get a cost of $250 minus $75 for a depreciable basis of $175. And in the second year, it's a simple calculation. We do 175,000 divided by 29, and that gives us 4487. That's the current year depreciation. And that is the number that's going to carry to the depreciation for assets placed in service in earlier years. The amount of depreciation that would have been claimed in the earlier year can also be figured because you take 4487, which is a full year amount of depreciation, you divide that by 12 and multiply it by 11.5, and that gives you the amount of depreciation that would have been claimed in the earlier year. And when you add the earlier year depreciation to the current year depreciation, you have total accumulated depreciation, which is a number you need to enter on your depreciation schedule. So the number that we enter is 4487, and that actually goes right here on line 17. I think earlier I told you the commercial property goes on line I. I was wrong because it was placed in service in an earlier year. It doesn't go on line I. Only goes on line I in the year you place it in service. Any depreciation for assets placed in service before the current year go on line 17. So that's probably why some of you are confused. I forgot. Then we have the cell phone. Cell phone is 7-year property. And we had to multiply the cost of that cell phone out by the business use percentage of 45%. We got $68. We enter that on the line. The recovery period is 7 years. The half-year convention, double declining balance applies, and it's a $10 deduction. We add up the numbers that appear here, 2,811, 10, 113, and then the 113 is from Part 5 for listed property. And we total all of those up. So to get the total here in Part 4, we really have to go do Part 5, so let's go do that. There are some extra instructions I should tell you about in here. When you're doing a Schedule C, the Section 179 deduction is figured on the 4562 and included as an expense on Schedule C as depreciation. But when you are working with an S corporation or an LLC, they do not become part of the depreciation deduction. They carry to a special line on the K1. We'll cover that when we get to our class on S corporations and LLCs. For the most part, 4562, the rules for filling it out are the same for all entity types that might file them. But there are some subtle differences when we get into the Section 179 deduction. And for today, though, we're just going to apply the rules for Schedule C. So here we are in Part 5 of the form. Zoom in a little if I can. We can see we've listed the car, the date placed in service on the car, the business percent use on the car, the original cost in the car, multiplied by the business use percentage gives us the $16,289, and the amount of elected cost on it is $1,561. We're limited by the limit on automobiles, so it's 51% of $3,060. That's the number we enter. We're stuck there, nothing extra. Then on the laptop computer, that is listed property used less than 51% for business use. So we enter the date acquired, the business use percentage, the cost, the depreciable basis of the computer, the number of years we will depreciate it over. It's straight line with a half-year convention. That gives us 113. I see Lena Young saying, why is depreciation for the car not included? For all of the reasons we discussed before the last break about the limits on automobiles. A car can never have more than $3,060 of depreciation in the first year it is used in business when bonus has not been claimed. And then you have to take that $3,060 limit and multiply it by the business use percentage. 3,060 times 51% is the amount of depreciation we get, and the limit includes all forms of depreciation, including bonus, Section 179, and any other maker's type of depreciation. We're done. $1,561 is all we get on that car. 16,289 should be 51% of 35,000. Yeah. Oh, you know what? It could be 51% of 35,000 minus 1561. It's probably giving us 16,289. Yeah. Yeah, that's what it is. 35,000 times 51% minus 1561 leaves us the basis for depreciation. I had to stop and think about that for a minute because I have no numerical ability to look at a number, multiply it by a number, and get another number in my head. I have to use a calculator too. All right. And then, of course, the cell phone gave us $113. We've got $1,561 of Section 179 deduction that will carry to line 7 on page 1. And then we have $113 that will carry to line 21 on page 1. And then, of course, in the problem, I gave you some business use information on that card, didn't I? There was a reason I did that, because you have to fill out this section and answer these questions. The total business miles during the year, the total commute miles, total other miles, and then, of course, the total of all miles. And then the questions, how I answered these, well, we just made those up. In real life, you would interview your client and find out the answer. Was the vehicle available for business use and off-duty hours? Probably. Was the vehicle used primarily by a more than 5% owner? Probably. And is another vehicle available for personal use? Well, most of the time. But of course, you have to ask your client those questions. So that's the 4562, page 2. Let's back up and, oops, pushed plus instead of minus, and go back up to page 1. And here we are again on page 1, and we've entered that $1,561 of depreciation under Section 179 for the car. We've added that to the Section 179 deduction on the desktop computer and the desk to get that $2,811. We have depreciation on the commercial building for an asset that was placed in service in an earlier year, and that's $4,487. Then on line 10, we enter, not line 10, line 19C, we enter $10 as current year depreciation on the cell phone. And then the depreciation on the laptop computer carrying over from Part 5 is $113, and that means the total on line 22 is the sum of all of these numbers, $2,811, $4,487, $10, $113, and $74.21. And if we're preparing a Schedule C, this is the number that will carry to the depreciation line of the Schedule C. If we are preparing an 1120S or a partnership return, this $2,811 is going to carry to the Schedule K. It will not become part of depreciation. And so for partnerships and S corporations, there's a little bit of a difference in treatment there. And then we have the 4562 for the residential rental property. That one should have been much easier for you because we're not dealing with any Section 179. We're not dealing with any bonus. It's simply a matter of getting those deductions on the correct line. And we have the 5-year property. What was it that we placed in service? A refrigerator? I can't remember. A refrigerator? Okay, so costing $500. It's in use in a rental, so it's a 5-year property. 500 divided by 5 years, divided by 50%, multiplied by 200%, gives us $100 for the first year. And then the residential rental property placed in service in the middle of the first month of the year, $100,000 divided by 27.5, divided by 12, multiplied by 11.5 gives us our deduction of $34.85. 100 plus $34.85 is $35.85. So that should have been really super simple to fill out compared to the earlier illustration with the business property. So with that, would you like to see what this particular return looks like in our computer software? How we did it? Okay, so just give me a minute while I load it up. Okay, folks, I just had to get to a point where I could even show you anything, and I think I am there. So now I will share my desktop with you. I don't know how good this view will be. I'll try and make it good. Yes, I like Superman a lot, more than the average person. Okay, so this is Drake software, and I am trying to, I can see through the window that you can see this, sort of. Drake software has good points and bad points to it. The good point is it's fast. When you know what you're doing, you can enter stuff real quick. The bad part is if you don't know what you're doing, it is not a crutch. It will do it wrong if you don't do it right. So we've created a return, and this is just classwork depreciation, and what I'm interested in is carrying my deductions to 2 business schedules, one of which is a Schedule C. I just had to put some income on here to make it possible for me to claim a Section 179 deduction. So the first thing is if you have a business with no income, you won't be able to claim a Section 179 deduction, right? It's going to force a carry forward. So we threw a number in here to give it income. Then on the rental property, Well, we didn't need to bother with that. It's okay for a rental property to run a loss and claim depreciation. So all we did is just trigger the computer recognized 2 business documents. We then go over into the 4562 screen to start making depreciation entries. And you can see each line here represents a different line item that you have on our answer key. That answer key that you have, the printouts that are in it, are directly out of this software. So the first thing I'm going to list is the car. What kind of information did I have to give this computer in order for it to handle the car correctly? The first thing I had to do is tell it where to carry the car. So I told it to carry to the Schedule C. I have only one Schedule C, but you can see that there's a multi-form code here that tells my software which Schedule C to go to. I've indicated 1. If I left it blank, it would default to 1. But if I had more than one Schedule C, it would default to 1. So I have to know that if I have more than one Schedule C to tell it which Schedule C to carry it to. And if I have multiple rental properties, which is more common, I have to be careful to indicate which rental property a particular depreciation line needs to go to. I then enter a description and the date acquired and the cost of the property and the business use percentage. Over here it says listed property type. I click on the down arrow to reveal a menu of choices. The first one is V, and that's the one I selected. This is a car under 6,000 pounds. If I do not tell my computer that this is a car with a code V, it will not apply the limits on automobiles. It will do it wrong. There's no way for my computer to know that because I typed car here, it has to apply the limits on automobiles. That's my mind knowing that it does, and I have to figure out in the software how to do that, so I select V for vehicle. Other options are certain electric vehicles or a truck and van. That gets the $200 higher limit. I would put a T if it were that. Then I have vehicles in the 6,000 to 14,000 pound range. Those are still listed property, right? And then I have non-limited vehicles, which have no limits applying, and then I have listed property other than a vehicle. So if I have a vehicle in the 6,000 to 14,000 pound range, that would be my SUV that I'd be concerned about. But if it's not an SUV, then I would go to all other forms of listed property other than a vehicle, or I would go to non-limited vehicles. Now the laptop has to be listed, right? How is my computer going to know it's listed if I don't tell it that it is? Okay, then I have to select the method, and my computer has a drop-down method with all of these choices. And the choice I'm going with is its makers, and it defaults to 200 declining balance. But there's also alternate makers for 150 declining balance. If I were a farmer, I'd have to select that. And then, of course, it offers other things like ADS or amortization or software, straight line 3 years. It won't know to put software on line 16 if I don't tell it. Okay, then we've got the life of the property. And here we've forced an entry for $1,561. We basically figured out what that is. I go page down and we've got the office building. Again, going to the first Schedule C, a description, the date placed in service, the cost. And in here, the code for that is accelerated real property 31.5 or 39-year life. And I've entered 39. It also asks what the prior year depreciation was in the earlier year. And we've entered salvage value here just to subtract the land out of the cost. Another way to do it would be to have 2 depreciation entries on the computer, one for land that you're not depreciating at all, and the other for the residual structure itself. Either way works. If you do it this way, it will fill out 4797 differently than if you have 2 lines. So 4797 kind of cannot fill out correctly when I do my depreciation schedule this way. And our software does have a line down here for land value. It's a relatively new line. Drake didn't used to offer it. Yeah, land cost. It has a place right here where I can put it. But it didn't used to offer that, so we got in the habit of putting it in the salvage value line because there was nowhere else to put it. Then we have the rental home. This time I've told it to go to Schedule E. And I've entered the cost, the business use percentage, and in this case ARR, which is accelerated residential rental. And then I've told it the number of years, the land value. On the refrigerator, we've got a cost of $500. I've told it it's 5-year life, and that it's going to the Schedule E. On the cell phone, 45% business use. We used to have to mark that as listed property, but not anymore. And it's 7-year property. The laptop computer is listed property, and because it's listed property, it is alternative depreciation system. I have to check that it's listed property, and I have to tell the computer it's ADS rather than makers. And 5-year life. Then we have the desktop computer. How did my computer know to expense it? Well, I selected expense, section 179. That made it easy. And on the desk, the same thing, expense. So when I'm done with all of that, and I process this return, I get my depreciation schedule all finished in here and my 4562. So here's the 4562 for the desktop computer, the desk, and Schedule C. It's all filled out. Here is the 4562 for the Schedule E, and then I have the depreciation schedules in here. So that's how it all works. None of this comes by magic. You can say I had to make a lot of very conscious decisions, applying a lot of depreciation rules to get to this to fill out. Now, if you're using Lacert, and I'm trying to think Pro Series in particular, I used that at one point, and it really walked you through a lot of stuff to make decisions for you. When you don't know what you're doing, it can kind of be a crutch. And you might have a software that has been doing all of the thinking for you for so long you don't even realize what it's thinking its way through. But Drake is not one of those softwares. You got to know what you're doing, or it will give you the wrong answer every time. All right, back to class. And we are, oh my gosh, only 15 minutes left in the day. It always flies by so quickly. So let's move into our manual. And the manual has a couple of more illustrations, but let's just finish off the day with going through the line-by-line instructions for Form 4562, because I think those are rather important. We've been talking about them piecemeal, but at this point, we're going to just take a dedicated look piece by piece on the form. You've had some time to study it while we were working on the classwork assignment. Let's take another closer look at it. Come here. Pushing it up. All right. So 4562, I'm just taking it section by section, and the first section is part 1 on line 1. You need to fill out a worksheet to figure the amount to enter on line 1, because of course that amount may be 500,000, but it could also be more than 500,000, and in certain situations you might be limited to less than 500,000 in the case of leasehold improvements, for example. You enter the total cost of all property, including the total cost of qualified real property that you elect to treat as Section 179 property placed in service during the year on line 2. And we've seen how that works. Then on line 3, we're going to use a worksheet from the Form 4562 instructions to figure out the amount to enter on line 3. So figuring out your true threshold cost of Section 179 property can take a little bit of calculation. So there is a worksheet to do that. And that's what we have here. Maximum threshold cost. I'm not going to read the worksheet to you, but there it is. Line 4 of that particular section, if the combined totals of all assets shown on line 2 is more than the total of line 3, subtract line 3 from 2 and enter the result here. So we have an example that XYZ Inc. placed in service $2,010,000 of Section 179 property during the year, and that's $10,000 more than the limit. So we're going to take $2,010,000, subtract out $2 million, and it means our maximum Section 179 deduction will be reduced from $500,000 down to $490,000. Thank you. And then we subtract line 4 from line 1 and enter the result here. If the amount on line 4 is greater than the amount on line 1, the Section 179 deduction is 0. And here is an example. XYZ Inc. must reduce its maximum allowable Section 179 deduction by $10,000 as follows. $500,000 minus $10,000 equals $490,000. XYZ can claim a maximum Section 179 deduction of $490,000. And then we provide a description for each asset for which a Section 179 deduction is being claimed, but do not list any asset which is listed property. Instead, you list listed property in Part 5. Then on line 11, you enter the total cost that you are allowed to deduct. It is limited by your taxable income. and then we move on to Part 2. Part 2 is where we enter the bonus depreciation allowance if we are claiming one. And so far today, I've been going out of my way to avoid it as much as possible. There's a couple reasons why I've been avoiding bonus. The biggest one of which is that it's a temporary law, and when it goes away, you need to understand what to do with the rest of Form 4562 is. But when you do claim bonus, you figure the bonus amount and enter it on line 14. Then line 16, you enter all other depreciation, including depreciation figured using acres. Of course, acres would only apply for assets placed in service before 1987, and all the research I've ever done on acres is that the maximum life claimed under acres was 20 years, so I don't know how you'd even have an acres deduction anymore. But then again, I'm not a specialist on acres, right? If you have acres, it goes on line 16, but more often what you will enter on line 16 is depreciation that you are claiming on computer software. That is the line it is entered on. Then in Part 3, under makers, line 17 is where we claim a deduction for assets that were placed in service in earlier years. And then for assets placed in service during the current year, for each class of asset, we will enter the total cost of property placed in service in that class during the year. We will enter the recovery period and the convention. And of course, the convention will usually be the half-year convention, but if more than 40% of the value of assets placed in service during the year were placed in service in the final quarter, we will enter MQ for mid-quarter convention rather than half-year convention. And then we enter the method, which is usually going to be 200% declining balance, but it might be 150% declining balance. Then you could elect straight line as well. And then finally, the depreciation deduction. Then on line C, or section C, we enter assets placed in service during 2011 using ADS. On lines 20A through C, you provide information as required for each asset class placed in service during the year using ADS. The following types of property must be depreciated under ADS, and they include tangible property predominantly used outside of the United States, tax-exempt use property, imported property covered by an executive order of the President of the United States. That sounds very serious. And then property used predominantly in a farming business and placed in service during any tax year in which you make an election under Internal Revenue Code Section 236AD3 not to have the uniform capitalization rules apply. Part 4 is a summary, and the main deal about Part 4, I've mentioned it a couple of times, is that when you get to line 22, partnerships and S corporations do not make an entry on this line for any expense deduction claimed under Section 179. Instead, you claim that Section 179 deduction to Schedule K and K1. And then listed property in Section A of Part 5. On line 25, we calculate the Section 179 expense deduction before calculating any special depreciation allowance. Then on line 26, provide required information for listed assets used more than 50% in a qualified business. On line 27, we provide required information for listed assets used 50% or less in a business. In Section B, we provide information on use of vehicles. This is mandatory and not optional. Kind of a pet peeve I have is looking at tax returns prepared by other preparers who leave it blank. It's sloppy, it's inefficient, it's inaccurate, it's wrong. You're supposed to fill it in, and the deal with your clients is getting this information from them is excruciatingly difficult. You ask them for the information and they don't give it to you, so you ask for it again and a third time and a fourth time, and finally when you're ready to strangle them, you say, look, I need the information. Please tell me the number of business miles you drove, also the number of commute miles you drove, and the number of personal miles you drove. Well, why do you need to know the number of personal miles? Because the form asks for it. I have to put it on there. So, no, you don't get a deduction for commute. No, you don't get a deduction for personal, but the IRS wants to know it. It's called disclosure. You have to put it on there. Okay. Then we have Section C, questions for employers who provide vehicles for use by their employees. If you are an employer who provides a vehicle for use by your employees, you need to fill out this section. And finally, Part 6, amortization. Claim amortization by completing Part 6 of Form 4562. You will enter a description of the asset, the date that amortization began, the amortizable amount, the code section, the amortization period or percentage, and the amortization for the year. I would say the biggest thing to know about Part 6 and how it compares to makers is that you don't apply a convention. There's no mid-quarter convention, there's no mid-month convention, there's no half-year convention. It's simply straight line. But what the IRS does say is that any asset placed in service in a month will be allowed full depreciation for that full month. So if you place it in service in April, you will get all of the month of April as an amortizable month. You will not get January, February, March. So if you place an asset in service in April, you will get 9 months of amortization. You're not going to be worried about half a year of amortization or a mid-month on amortization. You get the whole month. All right, and that is line 43. So password number 3 is Finch, F-I-N-C-H, Finch. It is now time to complete the session 15-16 classwork assignment number 3. So please flip to page 63 of your manual, and if you recall at the end of session 15 I had you complete classwork assignment 2. Classwork assignment 2 asked you to prepare depreciation schedules for the business activity of the Schedule C and the business activity of the Schedule E, and then of course we reviewed the answer key for those depreciation entries. Now that you have the correct depreciation calculations for classwork assignment number 2, we would like you to start working on classwork assignment number 3. And for classwork assignment number 3, we would like you to prepare forms 4562 for the Schedule C activity and the Schedule E activity. You of course may refer to the classwork 2 answer key. As you're working your way through it, it's loaded with lots of hints. For example, what line of Form 4562 this calculation should ultimately go on. I don't really have a problem with you reading through that, but if you're able to figure it out by yourself first, that's great. Otherwise, just do the best job you can of working through the answer key and entering your responses for classwork number 3 onto Form 4562. So at this point, please push pause on video playback. Complete classwork assignment number 3, and when you are ready, please resume video playback for a review of the classwork 3 answer key. And I now have the answer key for classwork assignment number 3 up on the screen in front of you. Of course, your job was to complete Form 4562 based on the depreciation information we were providing you in classwork number 2. Let's move over to the depreciation schedule. We have up on the screen in front of you now Form 4562, and you can see where it's asking for the business activity. We've entered Schedule C1, meaning that if there is only one Schedule C, that it would be for the first Schedule C. But if there's more than one Schedule C, each Schedule C would have to have its own 4562. The maximum amount of Section 179 deduction is generally pre-filled in on the form at $500,000. But the next line, line number 2, is a line you did need to fill in. The total cost of Section 179 property placed in service during the year. We've entered $20,792. Where did that number come from? Well, in line 2, we take the total cost of all listed property in Part 5 of Form 4562, plus the cost of property eligible for the Section 179 deduction. So essentially, we had the $17,850 cost of the car, plus the $68 cost of the cell phone, $1,125 laptop, $800 for the desktop computer, $450 for the desk, plus the $500 cost associated with the fridge that is used in a completely different activity. So the total cost of Section 179 assets that were placed in service during the year is $20,793. Well, you might be asking, how was I to know where that number came from? The answer is you look at the total cost basis of all assets placed in service multiplied by their business use percentage that were eligible for a Section 179 deduction, maybe. And although the asset placed in service in the rental property is not eligible for the deduction, it's still figured in as property that could have been eligible if it were in the correct activity. And that's where we get the total that we entered on line 2. Then on line 3, we enter $2 million. That's the upper limit that is allowed on the value of assets placed in service during the year. We're clearly nowhere near $2 million worth of assets placed in service during the year. So the dollar limitation for our Section 179 deduction is not reduced. We are allowed a full $500,000 if we can come up with $500,000 worth of expense, but we can't. We're only going to come up with the amounts that we actually entered on the form, and we have a desktop computer at $800, a desk at $450. Those two assets combine to total $1,250, but we also have to factor in $1,561 of Section 179 deduction from listed property that we calculated on line 29 of the form. So let's go over to line 29 of the form, and we will see that we're on page 2 in Part 5 of the Form 4562. And ultimately, quite frankly, when you fill out Form 4562 and you are dealing with listed property, you should fill out page 2 first. So here on page 2, we provide information about the car on line 26 and the laptop on line 27. Well, what's the difference between those two lines? Well, on line 26, we're going to enter property used more than 50% in a business. The car was 51% business use. We enter the cost of the car. We multiply that cost by the business use percentage. And then, of course, we enter the depreciation deduction allowed on the car, which is $3,060 multiplied by 51%. We then move over to line 27, where we list assets that are listed property used 50% or less in a business activity, and in the case of the laptop, it's 45%. The cost of the computer is $2,500. The basis for depreciation is $1,125. It's 5-year property, straight line with a half-year convention, and $113 deduction. The laptop is not eligible for a Section 179 deduction, therefore it is not included in the total on line 29, and instead the amount on line 28 will carry over to page 1 and get entered on line 21. But the amount on line 29 will be carried back to page 1 and entered on line 7. And here we are again with line 7, $1,561. We add that to the $1,250 of depreciation for Section 179 deduction on the desktop and the desk, and we're left with $2,881. Our deduction for the Section 179 deduction is not limited, so we take the lesser of line 5 or line 9, and in this case, line 9 is the lesser number. Next, we look at depreciation deductions for assets placed in service in years before 2011. The only asset placed in service in a year before 2011 is this office building and land. And if you recall, we figured the depreciation amount on that office building as being $4,487, and it is the amount that is entered on line 17. On line 7, we have the depreciation deduction being claimed on the cell phone. The cost of the cell phone was $150, but we multiply that out by the business use percentage of 45%, and it leaves us with $68 to enter in column C. It's a 7-year recovery period with a half-year convention, 200% declining balance, and it gives us a $10 deduction. On line 21, we've pulled over the depreciation deduction from Part 5 for the laptop computer. That was $113, and now we add up the numbers. Line 12 plus line 17 plus line 19 plus line 21 equals $7,421. The next step is to prepare the depreciation schedule for the rental activity, and that was relatively simple. We are not able to claim a Section 179 deduction for the rental activities, so no part of Part 1 is complete. Part 2 also is not completed. We move on next to Part 3, and in Part 3 we simply list the dishwasher, 5-year property with a half-year convention, 200% declining balance, and a $100 deduction. On the residential rental property, we have a $100,000 cost basis. Over 27.5 years, applying the mid-month convention, it gives us a $3,485 deduction. We total up $100 plus $3,485, and on line 22, we enter $3,585. So that completes the review of the Classwork 3 answer key. Let's move on now with Classwork assignment number 4. Under Classwork assignment number 4, we have a character named Nina Para. She purchased a residential rental property located in London, England. She has the following assets to depreciate for 2011. Complete her Form 4562. You can see that we have a rental property, we have a rental townhouse, and we have a washing machine placed in service inside that business activity of a Schedule E. Her business use percentage on both those assets is 100%. Her land value on the rental townhouse is $57,000. Please push pause on video playback and complete classwork assignment number 4. When you are ready, resume video playback for a review of the answer key. And I now have the classwork 4 answer key up on the screen in front of you. The key thing to have noted about Nina Pera's rental property is that it is located outside of the United States. And since her property is outside of the United States, she is required to depreciate her property using straight line under the alternative depreciation system. She can't use makers, she can't use double declining balance. And also under ADS, she's going to have extended or longer depreciable life for her assets. So you should complete her depreciation schedule under Form 4562 as we see here. We have the rental house with a cost basis of $100,000, land value of $37,000, giving her a basis for depreciation of $63,000. Her depreciable life is going to be 40 years straight line. She will still apply the mid-month convention. The rate of depreciation under that convention and life for the number of months in service for the year is 1.771, and you would get a current depreciation deduction of $1,116. We carry that down to line 20C of the 4562 for Nina Pera, and on there we enter the date placed in service, or in this case the month placed in service, the depreciable basis, the life of the property, mid-month, straight line, and $1,116 deduction. Next up is the washing machine. We show a depreciable basis of $899. The life on that asset is 12 years, straight line half-year convention, again under ADS. The rate is 4.167 or $37. So we're going to enter $899 on line 20B. 12 years is the life, half-year convention, straight line, and $37. On line 22, we total up her deduction as being $1,153. So that completes classwork assignment number 4. Let's move on to classwork assignment number 5. For classwork number 5, you need to complete another Form 4562 and another depreciation schedule. We figure the more of this you do, the better practice you'll get, and the better you'll get at understanding how all of this depreciation stuff works. Perry Polar Bear started up a new business during the year. He placed the following assets in service. Perry will not claim bonus depreciation or Section 179 deduction for any of these assets. He will not claim a deduction for startup costs and chooses to amortize them instead. Prepare his depreciation schedule and his Form 4562. You can see that the business activity is a Schedule C. He has freezer cases, business startup costs, a building, 5 parlor dining sets, and a point-of-sale system, which is a computer peripheral. Your job, using all of these cost amounts here and dates placed in service, is to figure out his depreciation deduction for each item and to complete his 4562. So at this point, please push pause on video playback and complete classwork assignment number 5. When you are ready, please resume video playback for a review of the answer key. And here I now have the classwork 5 answer key up on the screen in front of you. And we complete Perry Polar Bear's depreciation schedule as follows, beginning with the freezer cases. The cost on those was $6,217. The date placed in service was March 1st. And actually one of the things I like to do is go through here and make sure we're not going to be subject to a mid-quarter convention. Placed in service in January, placed in service in March, placed in service in February, again in March. So we know that not more than 40% of his assets were placed in service in the last quarter of the year. That didn't happen. So he's going to have a half-year convention applying. We go to cost, business use percentage, depreciable basis, and life on the freezer cases. Apply the 200% declining balance method. That simply gives us a rate of 20% and a current year depreciation deduction of $1,243. On business startup, we have amortization, and amortization is, of course, over 15 years. And rather than look at double declining balance or the half-year convention, instead we go with straight line over 15 years, and we will include a depreciation or amortization deduction for the month placed in service. So what that means is even though it was placed in service really the middle of February, we're going to get a full month of amortization for the business startup in February. So again, amortization is reported in Part 6 of Form 4562, and I don't have the full form in front of you on this answer key. I've just got a cutout from the very bottom of page 2 of Form 4562. When you look at the bottom of page 2 of Form 4562, you enter the description of the asset, and I'll just zoom in so you can see that a little more clearly, which is business startup, the date amortization begins, the amortizable amount, the section code, which is section 195, the amortization period or percentage, in this case 15 years, and the amortization deduction is $2,696. Next, we look over at the front page of Form 4562 and continue on with the depreciation calculations we've got going on here. We have the building, which has a depreciable life of 39 years, a cost of $249,000 with a land or salvage value of $102,090. So that gives us a basis for depreciation of $146,910 over 39 years, straight line, mid-month convention, and a percentage of 2.244. The deduction is $3,297, and that will be entered right here on line 19I, $3,297. Moving over to the 5 parlor dining sets, cost $39.95. The depreciable life is 7 years, 200% declining balance with a half-year convention, and a deduction of $571, which you can see we followed through and entered right here. Then we have the point of sale system, and that system has a cost of $5,699, a 5-year recovery life, and 20% maker's rate, leaving us with $1,140 of depreciation. Well, if you take $1,140 of depreciation for the point of sale system and add that to the $1,243 of depreciation on the freezer cases, you end up with $2,383 of depreciation for assets that have a 5-year life, and that's why we've entered $2,383 on line 19B, but we've entered Statement 1, and Statement 1 provides a description of the items that would normally appear in these columns. And there's simply not enough space for more than one asset. That's why we attached a statement. Next step is to add up the depreciation deductions. We have $2,383, $571, $32.97, and a total of $62.51. You will notice that the amount on line 22 does not include the amount from line 44, because line 44 typically will be claimed as a business expense under the other expenses line on Schedule C, whereas the depreciation deduction will carry over to the depreciation line of Schedule C. So that concludes the review of the Classwork 5 answer key. Let's take a look at Classwork assignment number 6. And Classwork assignment number 6 asks you to prepare Form 4562 and a depreciation schedule. This time we're assuming the same facts as in number 5, except that Perry has decided to depreciate all assets straight line rather than using accelerated depreciation. Now we want you to complete his depreciation schedule a second time and a different Form 4562, applying the different depreciation methods. So at this point, please push pause on video playback and complete Classwork assignment number 6. When you are ready, resume playback for a review of the Classwork 6 answer key. And I have the Classwork 6 answer key up on the screen in front of you now. Your job was to prepare Perry Polar Bear's depreciation schedule and his 4562 using the straight line method. And so we have all of the same assets that we had for Classwork number 5, the same cost, the same salvage or land value, the same basis for depreciation, and even the same life. What changes is the rate of depreciation and the depreciation deduction being claimed. So here we have straight line half year with 5-year life. The rate is not going to be 20% because we're not claiming double declining balance. We're claiming straight line. So the rate goes to 10% down from 20. That gives us a current depreciation deduction of $622. Amortization is unchanged on the business startup costs, and we're already straight line on the building, so that also is the same. Moving over to the parlor dining set and the point of sale, those amounts are adjusted to the straight line method, and the depreciation is essentially half what it was on Classwork assignment number 5. So beginning with the review of the 4562 for the amortization, again, the entries in this section are the same as last time. We have business startup, the date placed in service, the amortizable amount, the section code, the life of the asset, which is 15 years, and the amortization deduction. Moving over to the 4562. On line 19A, we've said see statement number 1, and then statement number 1, we list the two assets that had a recovery period of 5 years. The straight line depreciation amounts that we calculated are $622 and $570 for a total of $1192, and $1192 is the amount we entered on line 19B. On line 19C, we enter the cost basis of the 5 parlor dining sets, which are depreciable over 7 years. We're going half-year convention, straight line, $285 deduction. The non-residential rental property has the same depreciation as in classwork assignment number 5, which is $32.97. We add up our depreciation deductions on lines 19B, 19C, and 19I, and that gives us $4,774. So that completes the review of the Session 16 Classwork 6 answer key. Let's move on to the homework assignment. If you would please flip to page 67 of your student manual, homework assignment B involves preparation of Form 4562 and depreciation schedules again. And by now you should be kind of in the swing of those forms and have a little bit of an understanding of what you're supposed to do. And for homework assignment B, you're going to prepare a depreciation schedule and Form 4562 for each of the following assets. You can see that we have 2 business activities. One is a farm activity, and the other is a Schedule C activity. Your job is to apply the following rules. Number 1, assume all assets from both depreciation schedules are for the same taxpayer who is filing 2 different Form 4562s. Startup costs are to be amortized and will not be expensed. Claim a full Section 179 deduction for the copier and a $1,000 Section 179 deduction for the racehorse. Assume business income of $510,000. Do not take 50% or 100% special depreciation allowance. Assume the following facts on the car: the business miles are 17,000 and the total miles are 20,000, and that there are no commute miles. So your job is to complete the depreciation schedules and this Form 4562s for Part A and Part B. And I will see you next time as we begin Session 17 with a review of the Session 16 homework answer key. And after we've finished with that, you will take the Session 15-16 quiz. So have fun with this assignment, and I'll see you next time. Bye-bye.